Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. Tonight I want to explore whether investors can still buy the great travel stocks of Australia, Qantas, Flight Centre, Webjet, Corporate Travel and Hello World. These were smashed during the coronavirus crash of the stock market. Some courageous investors got in early and they've seen legs up. But the question is, when the borders really open up, will these stocks go up even higher? And the question is, is it too late or is it too early? Or have you missed that flight with these reopening trade stocks? It's a good question. Paul Rickard will have a look at that. He's from the Switzer report. Then Charlie Aitken of Aitken Investment Management looks at if it's still safe to invest overseas. A lot of headwinds coming from overseas at the moment, inflation concerns, a poor jobs number in the US. And he tells us about his most recent purchase he's added to his fund, which I have to say looks pretty interesting. And then Paul Myliotis of M Squared Capital tells us what he's seeing in the commercial property market right now. And then Ying Yi Ann Cheng of Coolabah Capital explains why we can forget the RBA and other central banks raising interest rates anytime soon. That's the show, so let's kick off with Paul Rickard and can we jump on board some of our best travel-related stocks? Well, the big question a lot of people are asking is, they've seen a lot of the travel stocks take off and they're wondering, have I missed a boat? We're going to talk about that now with Paul Rickard of the Switzer report. Hi, Paul.
Hi, Peter.
Well, it's a good question, Paul. Let's sort of set the scene for a takeoff for those stocks like Qantas and Webjet and so on.
Yeah, it's just worth recounting what's happened the last month or so, Peter. Probably the big news came out of Qantas back on the 26th of August. Alan Joyce seemed pretty confident about restarting Qantas flights from the middle of December. Now, that's built on the theory that when 80% of the population is vaccinated, if the government keeps to its plan, it'll reopen international borders to travellers, and also there'll be some special arrangements for vaccinated passengers. Maybe, for example, the hotel quarantine will be replaced by home quarantine. So he seems pretty confident. So he's gone ahead and announced a whole lot of things happening from December. You'll be able to fly, not quite around the world, but most places. We've also had in the last week or so, the Fiji government, Peter, came out with an announcement saying that they were ready to accept international tourists from November. And of course, both New South Wales and Victorian governments have got their own, have talked about vaccination freedoms when their targets are met. And that's got to be good for travel as well. So, and we've seen what's been happening in the US and Europe, where largely, travel continues. So it looks pretty promising in terms of something happening. My only caution, Peter, is that we've had 2 or 3 false starts before when it comes to international travel. So that's obviously the caution. But the market, most of the travel stocks has gone up by about 10 to 12% on the back of it.
Yeah. Let's go and look at the one I know you always like, Qantas. And here's a 5-year chart. What does a 5-year chart tell you, Paul?
Yeah, well, I just wanted to set the scene on Qantas first of all, just because what it shows you, Peter, is that the highs back before the pandemic around about just over $7. But if I go to the 1-year chart, which is the next one coming up on your screen, Pete, what you can see there, of course, is we've had about 3 or 4 times it's bounced off around about the 550 level, which is about where it is today, 545 or so. Now, the brokers have a target price of about $6 on it. My guess is that Qantas can get back up there towards that $6 level. I think there's a bit more left in this, into this sort of anticipation of the December reopening. I think Qantas is pretty determined, and certainly it's used the pandemic to really transform its cost base. It's reset its international program, and we've seen that with the collapse of Virgin and the start of some sort of Virgin competitor, its share in the domestic market has also changed for the better. So lots of positives for Qantas going ahead. It's just a question of what happens in the restart if it does the restart go ahead, and if it doesn't, does that mean the share price heads back south again? But I think there's a bit more left in Qantas. It should point out that the brokers don't expect Qantas to be profitable until FY23 at the earliest, and not getting back to its pre-pandemic levels until FY24.
Yeah, my guess is the first leg up, or we've seen a number of first legs up, but the most recent first leg up will be followed up maybe around March or even February if international borders are opening up a lot faster than we expect. Let's go to Flight Centre now, Paul.
Yeah, I want to show you the Flight Centre chart. Let's start with the 1 year chart, and just to make the comment that the brokers aren't quite as bullish on Flight Centre. They've got a target of only $16.86, and it's currently trading around $18.35. But at least in the last 12 months, Peter, it looks pretty much the same as the Qantas chart. We're back to sort of this level we've seen on at least 2 previous occasions. If I take you to the next chart, which is 5 years, you can see that Flight Centre was actually over $60 back in 2018-19. So we're a long way short of where it got to. I guess my only hesitation with Flight Centre, Peter, is that I'm just not sure that with the headwinds and sort of the whole travel agent model, just what happens to that going forward. And they've laid off a lot of staff. They've closed a lot of branches, so their cost base is in a much better position to withstand a steady recovery than it was. But I'm not sure whether we're going to get it back to $60 anytime soon. And I'm just not my number one stock in this area.
Yeah. And I guess a lot of people used to actually go to Flight Centre, and because of the coronavirus, a lot of older people who never used to buy stuff online have become really comfortable. So Flight Centre is going to probably have less people wanting to go to actual shops, and that could change the business model going forward. Let's go to Webjet now, Paul.
Yeah, Webjet's in the same vein, Peter, but a little different. I think it's more dependent on corporate travel than sort of perhaps on the retail market. And I'm not saying Flight Centre's not in both, but Webjet's a bit more on the corporate market. Again, look, trading pretty much where the broker's seat is, around about $6. That's pretty consistent with the target. And again, we're back up to that sort of level we've seen on 2 previous occasions in the last 12 months.
Okay, let's go to a particular starring one that's had a great time since the coronavirus crash, and that's corporate travel.
Yeah, and in a stock where there were a lot of short interest at one stage, I'll talk about that later, but yeah, I guess on that chart, it's actually been in a pretty steady uptrend for the last 12 months, and it's come up from about $16 up to around about $22. So, it hasn't done too badly. Brokers see it as going a bit higher. I think they've really survived, Peter, because they're much more global in orientation, and they're getting good business overseas. But certainly the market has liked this stock very much so over the last 12 months.
Now, the interesting one, and a much smaller cap one, is Hello World. What are you seeing there, Paul?
Yeah, this was pointed out to us because we know a couple of our fund managers that we look pretty carefully at it's gone back on their radar a little bit. So around about $2. The brokers are a bit mixed on this, nowhere near the coverage of the other stocks. Only a couple of the major brokers follow this. One's at about $3.15, the other's at $1.60. That's why the average is about $2.34. Look, again, your more traditional travel business, and again, the question is, it's over the last 12 months, it's actually, it hasn't gone up. In fact, it's gone down from where it was in November, December. Just what's going to happen to the traditional travel agent, I guess, is one of those unknowns. We're going to have to see how that plays out. There are arguments that say that people might need more help going forward with their travel because they'll be placing greater emphasis on safety and where they're going and what the accommodation looks like and all those type of things. I don't know, Peter. I think the jury's out on Hello World travel.
My view is, Paul, that if you go for Hello World or Flight Centre, you may well need a year to see a reasonable return out of them, where the other ones may well be far more reactive to open borders. But I still think there's upside with a company like Hello World. Let's go to the short positions now.
Yeah, and I think the last way to conclude this discussion, Peter, is look at the short positions. Now, these are the positions taken by the professionals in the market. In other words, they're short selling the shares. And this is the percentage of shares sold short. Now, what I always caution with people, this should not be your only guidance, right? I just put this up there because it's an input into decision making. And I think it's always interesting to see where the professionals are betting. Now, I make the caution is the professionals, they don't always get this right, Peter. We can think of spectacular examples where they got it horribly wrong, right? Yeah. Companies like JB Hi-Fi is a classic where they've always been short and they've been horribly wrong in that. But over time, you can't do this unless you make money. So they get it right more often than they get it wrong. And what that tells you is that they still some pretty big short positions in Flight Centre and Webjet. And by and large, and the other three companies are almost sort of, this is just within the normal range. So the professionals, see, if anything, aren't betting against Qantas, but they are betting against both Flight Centre and Webjet. And I guess that's just a note of caution. If you are looking to take a position through those companies, it doesn't mean that you can't do really well, but just bear in mind, there are some others in the market who have a very contrary position to what you hold.
Yeah. And the bottom line is, it would have been great if you got in maybe in April, May, June of last year. You would have made a lot of money, but these stocks were really smashed and crashed, and they have snuck up on the basis that normalcy is coming, and a lot of the easy money has been made. But I guess if you're a very cautious investor, probably Qantas is probably your safest bet, because it will grow over time, being a leading player in the industry, and even the brokers agree with that analysis.
Yeah, right. I think you're right, Peter. I prefer through Qantas, a bit safer. And I think there's probably a little more upside. I think we could definitely see sort of $6. Well, I say definitely, but I think there's a good chance we could see up towards $6 the next couple of months or so.
Okay, mate. Thanks for joining us.
Thanks, Peter.
It's Paul Rickard from the Switzer Report. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, for a look at investing overseas, we have Charlie Aitken of Aitken Investment Management. Good to see you, mate.
Yeah, good afternoon, Pete. How are you?
Very good. Before we start looking at some individual stocks that you might be thinking look like good value going forward, let's just set the scene. We saw last week in the US, Dow Jones was down 5 days in a row, but it wasn't down all that much. I think it was less than 2%. And there's a bit of instability around locally. We're a bit worried at the moment. And you've got, I guess, Delta is probably the big question mark for lots of investors. You've got inflation concerns. You've got the possibility that maybe the US is not growing as strongly as we expected because of that bad job number we saw last month. Putting it all together, there's a whole mixture of probably headwinds. Where do you think this market's going, Charlie?
Well, Pete, I'll give you one answer to that. It's September. People get nervous in September. Markets generally do a little bit wobbly in September, and it's doing a classic September. I think all of those issues that you mentioned are well known, and I don't see them as great concerns, quite frankly. And you've noticed that most of the pullbacks in US markets and global markets have been very, very shallow. I mean, cash rates still remain zero. Bond yields are very low. They've actually gone lower in recent times. And I think it's just a more of a seasonal pullback in equity markets, and it's a very small one, Pete. People always try to back solve why the market's moving in one direction or another, trying to point to some clear point. And I just don't think there is one at the moment. The markets have had an almighty run. The summer's ending in the northern hemisphere. They're probably a little bit fearful of the Delta variant in the northern winter. I don't disagree with that, but broadly, I still think equities look really good, Pete. We're fully invested. If we had more money, we'd be more invested. You know what I mean? There's so many opportunities out there I think look interesting, particularly as the world reopens. So I'm not concerned about the price action so far in September, and I don't think there's any giant indicator that tells me to worry.
Yeah. I've been saying in some of the pieces I've been writing that if the market pulled back for 4, 5 or 7%, I'd be a buyer on the basis that I look at 2022 and every economist who I respect tells me there's going to be a strong boom 2022, and that's got to factor into profits and corporate and ultimately stock prices over the course of 2022. Is that reasonable?
Yeah. Look, I think, it's not going to be the same easy PCP comparison to a year ago. We all know that. The 50%, 100% lifts off the COVID bottom. We get that, right? But that also comes into account with inflation readings, which will fade a little bit versus the PCP as the PCP goes higher. GDP growth, I think, is still going to be adequate. Look, I think there's plenty of reason to be optimistic about the year ahead. I think the vaccine rates are going up globally, and governments are learning to live with COVID, rightly or wrongly. I mean, you can see that. I have friends. You have friends in the Northern Hemisphere. I have a brother in London. He's going to soccer games with 80,000 people there. There's NFL games on in America with no spacing, rightly or wrongly. And I think, even though the darkest moment in Australia right now. I think we can look forward to that here as well. And I think the consumer spending sort of celebration that comes, Pete, whether it's going to restaurants, hotels, traveling, getting on a plane, will be very, very large. And it is worth being, leveraged in a portfolio or exposed in a portfolio to, dare I say it, sort of reopening stocks. So look, I'm optimistic on the year ahead. I think interest rates are going to stay at zero. I think it's very hard to get interest rates up. And the bond market is trying to paint you a picture of sort of Goldilocks, dare I say it, okay growth with lowish inflation with interest rates staying very low. Now, that's great for equities, particularly equities with pricing power, in my view. So, I broadly think the year ahead looks okay.
Okay. I know you made a point that Apple did a public show and tell recently. Was there anything there that made you either want to buy or sell Apple?
Oh, it just reminded me that this is a 2.5 trillion, I say trillion market cap company. I never thought I'd say that in my lifetime. But I suppose as the biggest company in the world, we've got to pay attention to it. We don't own Apple at the moment. We think it's a bit overvalued just versus its growth. We think there's basically better opportunities elsewhere. Think about it, Pete. What do you have to do to grow, to turn the dial on a 2.5 trillion market cap company? If the shares go up 10%, they go up 250 billion in market cap, a BHP basically. So they have to announce something enormous to drive revenue growth. Now, they're a good business, but 50% of the revenue still comes from the iPhone. And the iPhone 13 that was launched was not dramatically different to the iPhone 12. It's got a better camera. It's got better battery life. It's just a bit of an evolution. You and I and our kids won't just run out and get an iPhone 13 because it's got some new gadget. Probably hang on to our current one for a little bit longer. But look, there's also a little bit of increasing regulatory risk, Apple, in terms of the App Store. Bit of regulatory scrutiny coming to the App Store. If you look at the App Store, it's only 6% of Apple revenue, but it's 16% of profits. It's that profitable. And the revenue sharing deals they have with people who have apps, et cetera, et cetera. And 66% of it comes from gaming apps, people just sitting around playing on their phone and such. So I think there's a bit more increased regulatory oversight coming there. So don't get me wrong, Apple, great business, great company, great balance sheet, but very hard to drive growth when you're a 2.5 trillion market cap company, Pete.
Okay. What has been the latest overseas company that you've bought and why?
Well, the one we've added to and taken in well into our top 10 holdings is an US industrial business called HEICO. Now, it manufactures replacement airline parts. So I'm really quite bullish on the reopening trade, global travel, vaccine passports, whatever it is. People are stinging travel, Pete. Look, there's only so many laps of the block I can do. It is time to get on a plane. I've done the lap of the block in every direction, Pete.
And you don't get a glass of champagne when you do a lap.
No, just, no. So look, I'm very bullish on the aviation recovery. I think planes are going to come out of the desert. I think things are going to go broadly back to normal over the next couple of years. But there's a big replacement parts cycle needs to happen. And HEICO, which is only a mid-cap American company, majority owned by a family called Mendelsohn, who've owned it for 30 years, is a really, really good business. It does stuff like the tray table latches, the toilet latches, the brakes on the plane, the tires on the plane, everything you can think of that keeps a plane in the air. And they've got a fantastic safety record. They've never been involved in any accident or anything, or one of their parts hasn't failed in 30 years. But the best thing is that the barriers to entry here are enormous. You need to be approved by the FAA before you can put any parts on any plane. So there's huge barrier to entry there. So I just think it's a good business, great solid industrial business, mid-cap industrial American business with great balance sheet, but very good leverage to, global aviation really picking back up, because the bit we're missing at the moment is international travel. Domestic travel in America is well back up on the aviation sector. But once international opens up, I think it's really good for businesses like HEICO and really good for businesses like MasterCard as people travel. Just, people just getting out there and doing cross-border transactions and getting out there and spending some money. So there's a bit of wealth in the world now, Pete, where share markets are, where property markets have gone. Consumers have a bit of purchasing power, despite some stimulus fading from COVID. So I'm very bullish on the recovery in global travel, and that's one way of playing it.
Okay. You've been investing in this market for quite a long time, even though you are a very young person, Charlie. One thing I noticed was if you look at where the US market was before the crash, and you look to see what's gone up by, it's up 34%. So if you go back, you had the bounce, and then if you measured off where it was before, it's got 34%. in Australia, we're up only 5%.
Mm.
Now, that makes me think that next year there's a good chance that we could grow at a faster rate than the US market, even though the US market is going to go up. There have been plenty of times our market has grown fast because we've had lockdowns, we've had restrictions, we've had Fortress Australia. Could all this stuff, in a sense, help us have a bigger rebound on the stock market when we start opening up?
All comes down to China, I reckon, Pete. I mean, obviously, Australia's got more direct exposure to China, more than the US market. Remember, of the S&P 500, 6 mega cap tech stocks make up 25% of it. We don't have 6 mega cap tech stocks. In fact, we just lost one. We're losing one in Afterpay, I suppose. Yeah. So it's going over to Square. So Apple, Facebook, Microsoft, Nvidia, Amazon, and Google make up 25% of the S&P 500, and they've done the heavy lifting, as you know. They're one of the reasons. They're probably the vast bulk of the reason the market's 25% better than the Australian market. Look, I think the industrial recovery stocks in Australia look really interesting, whether it's a Qantas or a Wesfarmers or a Boral or something like that. Absolutely interesting. And there's a reason that the super funds are trying to take over Sydney Airport. That's a smart play. Buy it in a pandemic, super smart. Buy a 50-year concession in a pandemic. That's what investors should be thinking too. Buy really long duration, great businesses in a pandemic that'll go back to normal. I mean, we'll all be going back to Sydney Airport soon. It'll just be owned by someone else. So I think we need to be just a little bit careful in commodities because China is taking some slowing actions, as you can see, and the Beijing's becoming quite unpredictable in some of its behaviour. I mean, we saw Macau casinos yesterday, Peter, were down 30% a day. They just decided there was new rules. I mean, it's almost uninvestable up there, Pete. So we just need to be a little bit careful. Whereas I feel far more comfortable in America. And to be honest, I don't invest directly in Australia at the moment, but I think Australia will look great in 6 to 9 months' time. Imagine the pent-up demand here from people just sitting around. Our 2 major cities have been locked down for hundreds of days, hundreds. And it's not. I'm not even blaming anyone. I look to the future, and the future is a vaccinated world. We're out there out the normal, spending and doing normal things, enjoying our lives. So I think, yes, could Australia play a bit of catch up in certain stocks versus America over the next 12 months? Yeah, no doubt about that. But I think, like in all things, Pete, you just need to be a bit selective. It won't be everything. Yeah,
in many ways. And I know you jumped on board Microsoft when a lot of people might have thought, well, Microsoft has had a good run anyway. Are you getting on a horse that's already done enough running? But those really good quality companies can keep on running and keep going higher, as has been the case for Microsoft.
Well, you look at Australia, when you talk about quality in Australia, you think CSL, you think Macquarie Group, you think Wesfarmers, there's a short list. CBA, I think in the banks, that's absolutely fair. And it's those companies just keep on giving. Yeah, they have the odd month where they don't perform or something, but that's not the point. The compounding effect you get from those great, organic growth businesses that have dominant, industry positions is fantastic. So, look, I think we'll find more of those. They could be emerging, somewhere in the tech space or something. I don't know, but you've got to stick with your winners. I mean, that's the thing we all get wrong, Pete. We're all tempted to trim some Microsoft or CSL and then let Telstra be in your portfolio for 20 years. We all should have cut Telstra a long time ago. And got with things that had a bit more organic growth. Yeah. So look, I mean, I think that I'd be, Microsoft, even for us last week, announced a $60 billion buyback and a lift in the dividend. I mean, the numbers are telephone book numbers when you're dealing with it, but it's just still a great business. So my only advice or view to the listeners, Pete, would just be stick with your winners.
Good stuff. Charlie Aitken, Aitken Investment Management, a fund manager. Thanks for joining us.
Thanks, Pete.
We're joining him now for his view from the vantage point of being a player in the property market, particularly the commercial market, with Paul Myliotis from M Squared Capital. Hi, Paul.
Hello, Peter.
So what are you seeing, with property at the moment? We're always preoccupied with the residential price rises that are always in the news. And it's kind of relevant to you because you lend against the value of residential properties when people come looking for commercial loans and whatever. But what are you seeing?
Look, on the ground, we're still seeing a huge demand, a borrower demand from borrowers that need credit. And we're also seeing that investors have still got a thirst to invest in this space. So from that perspective, we haven't seen much change from what we're used to. What we are seeing a change in is the fact that the government support's a little bit different from what it was in the first COVID, when the COVID outbreak happened. We don't think the strength is provided by the government where it needs to be. So we are seeing a few cracks. We're seeing cracks particularly in the commercial space, in that we believe, look, tenants aren't going to be paying their rents. Not all of them are going to be paying their rents. People are struggling on the ground. Landlords, will be struggling making their repayments with the tenants not paying the rent. So either one or two things are going to happen. You're going to have a flood of commercial property in the market, or you're going to see a high vacancy rate. And that's notwithstanding that the actual commercial values of property are still very, very high. They're still performing very well. So residential is performing well, commercial still performing well, but we are quite cautious against commercial assets.
So Paul, are you saying then that there could be, so let's take, for example, if you had a commercial building in a suburban shopping area, and the actual function, the business there is not doing well because it's not a cafe, for example. Cafes are killing them in suburban areas. Yeah, it may well be a shop that has to be closed under lockdown rules. Are you saying that a shop like that, the landlord might say, I want to get out of this, and when he goes to sell, a buyer will say, hang on, this is affected by a temporary lockdown. When the lockdown's over, this is going to be a valuable property again. Is that the kind of thing that's...
It is. I mean, I think there's going to be a short-term shock before that, in that the government shored up the tenancies, in that landlords weren't charging any rents. Yeah. Now we're not seeing that grace period happen. Some landlords are saying, well, you have to pay me 50% of your rent. Other ones are saying, regardless that you're closed, you still need to pay me rent. So the actual tenancies are going to struggle and may not come out of this lockdown. If that happens and the landlords are not receiving their rent, there might be a short-term change in what happens in the marketplace. So we're very cautious with looking at those type of opportunities, but there are also some really strong opportunities. As you mentioned, certain cafes in suburban areas, they might be in takeaway only mode, but they're still making good money. Like we had an opportunity, for argument's sake, there was a petrol station that we lent against. Now, typically petrol stations, there's a bit of risk around them, but the tenant was a Caltex petrol station with a Woolworths lease. So the reality is you're not guaranteed, but the risk of losing the rent for that particular landlord is low. The other thing with that particular opportunity was that, look, it was a service station in Strathfield. If the tenant left, our valuer said the actual property would be worth more. So for our investors, it was de-risked. We take a lot of effort in our business to actually analyse the tenancy risk. Yeah. So we're not saying we're not looking at commercial opportunities, but we have to be very, very wary of the type of opportunities that we are providing to our investors, regardless of where it is and what it is.
What's happening? You indicated to me that US or overseas funds are starting to come in the market.
Look, we're seeing a fundamental shift, we believe, in the commercial space in Australia. The banks, we find, they've got capital restraints. On the ground, we are seeing a huge skill shortage in the finance industry across the board. So we believe the banks are going to continue with what the low-hanging fruit is, which is residential home loans. It's standardised. A house is a house. Residential is much easier to have to standardise and scale. Where that leaves is a massive gap in the commercial funding space. So what we're seeing is, like in the US, for argument's sake, 70% of commercial mortgages are written by non-bank lenders. In Australia, only 8% is written by non-bank lenders. But the most important bit with why we're seeing people come here is the returns investors are making. So in the US, if you're investing in the private credit space, your investors are generally getting 3% net returns. In Australia, like our investors are getting returns of 6.75 net. for property based in the eastern seaboard of Australia. So you're seeing people like Airs Management putting bids, and look, this didn't go through, but it shows you what's happening into AMP. You've got Apollo buying 50% of a non-bank lender. So you're seeing a seismic shift that they can see there's opportunity in the Australian non-bank lender, in the non-bank kind of sector. So we believe we are going to go a lot like what the US is, which is your viewers are going to see a lot more private credit opportunities. They're going to see a lot more commercial loans written by non-banks.
Okay. So what does that mean then for the people who lend you their money effectively as savers, and you then on-lend it to borrowers who are often commercial businesses who put their residential property up as collateral? What's that going to do in terms of, if there's more competition, will the returns offered to savers be higher or lower?
Look, we with more competition becomes a push down on returns. I mean, we're still seeing strong returns for our investors, as I mentioned before, that they're returning roughly, depending on the opportunity, 6.7% net. With more money coming in, you will find that returns go down. But our job as fund managers is to find that niche where we can give the lowest possible risk to our investors for the highest possible return. So, I mean, as I mentioned before, again, we gravitated to doing a commercial tenancy of a petrol station. We're gravitating to other sectors where we can see an advantage in the marketplace, which we're trying to hold our returns as high as we can for our investors.
Okay. One last question. You've painted a picture that's, some businesses and landlords are having challenges at the moment. Is that making you guys, more stringent in your assessment of what can go wrong with the people who are borrowing from you?
Look, we've got a very robust process in terms of how we analyse which deals we do. And it's not just about the collateral of a property. We look at the character of the borrower. We look at their history in terms of how they've repaid their mortgages. But collateral is a very important part. So what we're doing now is we've got a property team which analyses which sectors are the lower risk to lend to. So as we like the industrial sector, for argument's sake, so industrial property. Residential is very strong currently. So we being a secured lender, we lend all across the eastern seaboard of Australia, but we pivoted at the first COVID outbreak to residential property because we do feel that is the most resilient, and it's proven to be very resilient in your Melbournes, in your Sydneys and in your Brisbanes. They've performed extremely well. So is our process changing? We are very cautious in certain sectors, property sectors, but you still need to tick a lot of boxes before you look at collateral to do a deal.
Okay. Is there anything else you want to share with us from your insights from the sector?
Look, what I do want to say is we are seeing a lot of people pop up in our sector. So you need to be cautious on what the underlying security is. For argument's sake, we've seen people come to us and go, "Oh, Paul, we've seen opportunities at 10% net returns."
Yeah.
Well, that's great, but when you're only secured against a company and you don't have residential security behind it, I think you need to be cautious about those type of things. So if you don't understand what you're getting yourself into, just don't look at the headline rate of what you're going to be getting. I think we're seeing a lot more in this marketplace where people really want to get a return on their monies. So they're looking at anything and everything. Alternative classes of investment are there for your viewers to have a look at. But err on the side of caution when you see higher returns. Higher returns, sometimes they are fine, but you are going up the risk curve. You're not looking at a term deposit. You need to really understand what you're doing.
Yeah, that's a really important point, that when you're offered really high returns, they are simultaneously offering you higher risk, and that's the important point.
That's it. And look, sometimes even when you're looking at lower returns, we see some things saying, geez, it's a 4% return and you're still unsecured. So don't get skewed with just the return. Really ask the question, what am I getting myself into? What is the underlying security? In the unlikely event you don't get your monthly distribution, what are you falling back on from a collateral perspective?
Paul, thanks for joining us on the program.
Thanks, Peter.
It's Paul Myliotis from M Squared Capital. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining us now is Ying Yi Ann Cheng from Coolabah Capital. Thanks for coming to the program, Ying Yi.
Thanks, Peter.
Now, we always like to talk to you to get the latest feel about what might happen to interest rates, and a really important meeting in the US last week. I actually described it on radio as the meeting of the most boring people in the world. But it can actually have some of the most exciting outcomes for the markets, from when central bankers all get together and start talking about what they need to do for the world economy. It can really move markets. And last week's meeting and the address by Jay Powell, the Fed boss, really did have an impact on markets. So tell us what we learned from that meeting, Ying Yi.
Yeah, look, I mean, for many in the market, I suppose, if anything, it was considered more of a dovish taper. And perhaps you may want to sort of translate that a bit. But essentially, it was just very much that they're not in a hurry to necessarily, taper or raise interest rates or tighten monetary policy. And I suppose, his remarks, were very much consistent with possibly a tapering announced later in the year, which is aligned with the consensus view that people sort of took away from the July FOMC meeting minutes as well. So, for what's really sort of stood out from my perspective, if anything, is that, the recovery in the US will be strong enough for them to start withdrawing and tapering quantitative easing, i.e. bond purchases this year. What would potentially delay that is a surge of hospitalizations around, Delta. And, Peter, I'm sure you've been keeping an eye on, hospitalizations globally, but in the US, you'll notice that they're increasing quite dramatically. And in fact, we're getting up to sort of almost at levels that we saw at the very height of the pandemic last year, which is, quite serious despite, them being vaccinated. They do have a slightly lower vaccination rate than, say, for example, the UK and Canada. However, it's obviously still affecting them, even though they're more advanced in their vaccination rates than say, Australia, for example.
Yeah. And of course, I bet a lot of those high levels of hospitalizations are in states where they aren't vaccinating to the same level as, say, California and New York.
That's right. That's right. So I heard Carolina is quite serious. Yeah.
So one thing I took out of that address from Jay Powell was that he kind of said this, and how I like to bring things down to more simple analysis.
Yeah.
Okay, we might taper in September, but it'll probably be December. But you guys shouldn't be thinking about interest rate rises anytime soon. That's the kind of message I took from him. Did you
exactly.
get that?
Yes. Yeah. So, and I would quote that being substantially more progress needs to be seen before rate hikes can commence. So a tapering of asset purchases is imminent. So, not buying bonds. However, I think, in some respects, we need to take into consideration the labour market, right? So the labour market is not quite where it was prior to the pandemic and is still on the mend. And what will be particularly important for markets, in the coming weeks is actually Friday's non-farm payrolls. So that will give an indication of how the labour market is doing. And I agree with you, Peter, raising rates is still a long way off. And the Fed will want to be convinced that inflation is sustainably over 3% before they actually start hiking rates, even if they do taper imminently, as I mentioned.
Okay, so basically his message to the market helped the stock market go up, particularly tech stocks. They did very well because, as you know, they're affected by rising bond yields and whatever. You play in the bond market, and bond yields are really important to you. Let's just go out of America for a moment and concentrate on Australia, because we get national accounts numbers this week, and maybe I may well show this after that's happened, but let's just assume that national account numbers come in as a small positive rather than a negative. That's why my best guess. If we did get, say, double dip recession type talk, how would that change the way you guys might play the bond market?
Yeah, good question. I mean, look, really for us, firstly, we play in zero interest rate duration portfolios. That's the way that we run our portfolios typically. So there's no interest rate risk. So if there was the threat of inflation, then that doesn't affect our portfolios to the extent that we don't have any interest rate risk. With respect to a double dip recession, then I would expect that the RBA, who has been actually seemingly overly optimistic recently, particularly looking out to next year, we would actually expect them to, provide more support for, the economy via their current quantitative easing programs. So, currently they are purchasing $5 billion of bonds a week. Now, in July, they signaled that they would taper this to $4 billion a week. But we've got to remember, it's not so much the amount that they're doing each week that is important, it's the total amount that they do in, aggregate. And so, if they were to continue at, say, $5 billion until September, which is obviously, next week or this coming week, and then, they move to $4 billion, they could leave or continue with that quantitative easing program past the 6 months that, could be expected, given, QE1, QE2 were 6 months in total. So if that is going to be the case, we could expect them to, maintain at $5 billion, or they could actually increase those bond purchases. Either way, that is extremely beneficial for the actual bonds that they're purchasing, right? And the bonds that they're purchasing are Commonwealth government bonds and state government bonds, otherwise known as semis. Now, at the moment, given the lockdowns, as we know, the states are, bearing quite a lot of heat, particularly New South Wales and Victoria. And if anything, these lockdowns cost money. These states are going to have to issue debt. And if the RBA wants to be supportive of that, then it could, actually tweak their bond purchases. This is not necessarily our core view, but it's a scenario that could take place. If they were to tweak it, then obviously we expect them that to be particularly beneficial for state governments. So at the moment, of the $5 billion a week that they're purchasing in government bonds, they're only purchasing $1 billion. Even if they tweak it and increase that proportion, that would be incredibly beneficial. And, these state government bonds form, quite a significant part of our portfolio, because we expect that the states will benefit once they come out of lockdown, but they also continue to benefit from any, quantitative easing program.
Okay. Let's just cut to the bottom line, because people watching this who may well have invested in either other Coolabah bond funds or even the Switzer high yield fund. Is this going to be good or bad for returns? Oh,
it will be good for returns. Okay. It will be good for returns because really more buying at the end of the day, right? So, either way, I see it as good news on different sort of fronts. If the RBA wants to step in and provide more support on top of what they're already providing, then that means more demand for the bonds that we already own. The other situation would be actually if we come out of lockdown sooner. So, obviously we've been doing a lot of modelling around when we get to 70 to 80% vaccination rates. And, internally we think that's going to be early October, just based on the current trajectory. And if that's the case, then you should expect, an economic rebound after that, just purely because we have been prevented from doing a lot of activities currently, and once we reopen, we can go back to those sort of activities. So no doubt there would be an economic rebound. And actually the states themselves, you know, are actually spending about, like, for example, New South Wales is actually spending about 50% less than what they had actually budgeted on the cost of the lockdown.
Yeah.
So, you know, the sooner that we come out of lockdown, that will be good for growth and, you know, ultimately good for the bottom line of these states, because they won't have to issue as much debt. And once we reopen, you know, they'll get their GST revenue, they'll get their stamp duty revenue, payroll tax, land tax, etc.
Okay, so the final point then is, if we come out of this quicker than it might be expected and we rebound faster than people expect, is that going to be good for your bottom line? Or
that will also be good for our portfolios.
Good stuff. Fantastic. Good to see that most scenarios suit Coolabah Capital. Thanks for joining us, Ying Yi.
Thank you, Peter.
That's the show for this week. Thanks for joining us. And if you want to know more about the companies my experts like, then take a 21-day free trial of the Switzer Report. Go to switzerreport.com.au. Once again, thanks for joining us. I'll see you on Monday.